All right, let's get right into it. We're going to pull back the curtain on one of the most intense moments you can find in the financial markets. I'm talking about those first few minutes right after a huge economic data release. In this explainer, we're going to break down a professional trader's detailed playbook for navigating the total chaos of what they call a red event. Think something like the non-farm payrolls report. And let me be clear, this isn't about guessing, not at all. It's about a rock-solid, disciplined protocol.
So that's the big question, right? When those numbers hit the wire and prices start flying all over the place, moving at a speed that's just breathtaking, what really separates the pros from everyone else? Here's a hint. It's not about being faster. It's about having a better plan. And that's exactly what we're going to walk through, step by step.
Okay, first things first. We've got to define our terms. Before you can even think about having a plan for the battle, you have to understand the battlefield itself. So, what in the world is a red event?
So a red event is basically any scheduled news release that you know for sure is going to inject a massive dose of volatility right into the market. We're talking about the big ones, non-farm payrolls, CPI inflation data, a Fed announcement, you get the picture. But here's what's so important, and this is where the pros really think differently. They don't actually care if the jobs number is good or bad. What they care about is how the market's structure, the key price levels, the trends that are forming, how that reacts to the news. It's a subtle but absolutely crucial distinction.
And this slide just brilliantly illustrates why they focus on structure and not the headlines. Think about it. The exact same strong jobs number can be interpreted in two completely opposite ways. Scenario 1 is what we call risk on. Hey, strong economy, that's great. Let's buy stocks. But scenario 2 is hawkish. Whoa, a strong economy means the Fed is going to keep interest rates high, and that's actually bad for a lot of tech and growth stocks. So, how do you know which script the market is following? You don't guess. You can't. You immediately look at the key signals. Treasury yields and the dollar index, the DXY. They're like the market's tell. They show you, in real time, which interpretation is winning the day. Okay, so now that we get the why, let's see how this all builds into a concrete plan. The mission actually begins long before that 8:30 a.m. data hits. For a real pro, the most important work happens when the market is still quiet.
This countdown is totally systematic. At 7 a.m., the trader literally classifies the day. They might even say it out loud. Today is red event volatility, just to get their head in the right space. Then from 7:30 to 8:25, they're all about analysis. What do the futures markets do overnight? Are yields already trending one way or the other? Then comes the critical moment. 8:25 a.m., 5 minutes before the release. It's pencils down, everything stops. And this is a non-negotiable rule. The whole goal is to observe, not to gamble on that initial wild price swing.
And this right here, this is the mantra that governs that whole pencils down period. See, amateurs, they feel this desperate need to catch the very first explosive move. But the professionals, they know that's usually a trap, filled with fake-outs and really terrible liquidity. So the key takeaway is this. Letting that first move happen without you, that isn't a mistake. That is the mark of discipline. It's the mark of an expert.
All right, now we are entering the most dangerous part of the day. This is the initial shockwave right after that 8:30 a.m. release. And let me be really clear. The primary objective here is not to make money. It's to survive, to observe, and to gather intel for later.
The market absorbs news in a very specific sequence. It's not just one big bang. First, the index futures react instantly, violently. Then, the bond market and Treasury yields follow. And remember, that's what confirms the market's interpretation of the news. Only after that do the big ETFs start to adjust. And then, lagging way behind, sometimes by several minutes, are the individual stocks. And this is exactly why trying to trade a stock like Apple or Tesla on that first 1-minute candle is just a recipe for disaster. You're basically reacting to old news by that point.
So, an hour after the data, the stock market officially opens at 9:30 a.m. A lot of people think, okay, this is go time. But for a pro, it's still a massive danger zone. That first 15 minutes is dominated by huge funds and ETFs that have to rebalance their portfolios based on the new data. Their trading isn't strategic, it's mechanical, it's forced, and that creates these enormous choppy price swings. The protocol is crystal clear on this. That chaos is not an edge. You stay out.
And to really hammer home this discipline, the protocol has a list of what they call hard illegal trades. These are absolute break them and you're done rules. You can see the details here, but the spirit of it is simple. No trading too early, no fighting the trend, no messing with illiquid stocks, and absolutely, under no circumstances, do you make an emotional revenge trade after taking a loss. Breaking these rules is the fastest way to blow up your account.
All right, Section 4. We've made it through the chaos, we've watched, we've observed. Now, finally, we're entering the period where the high probability opportunities actually start to show up. This is what you could call the professional's golden hour.
So between roughly 9:50 a.m. and 10:30 a.m., that is the primary execution window. So why then? Well, because by this point, that initial violent rebalancing act is over. The dust has finally settled. A really key technical indicator called VWAP, that's volume-weighted average price, it's stabilized. You can kind of think of it as the true average price for the day so far, and once it settles down, it becomes a much more reliable guide for the market's real direction.
And any trade you take inside this window must follow the structure hierarchy. It's a top-down approach, and it's non-negotiable. First, the broad market index, say the NASDAQ 100, has to be trending in the direction you want to trade. Second, the specific sector ETF, like the tech sector XLK, has to confirm that trend. And only then, only if those first two are aligned, can you even think about trading the individual stock, like an Apple. If that chain of command breaks at any point, the trade is immediately off the table.
So what does a valid entry signal actually look like? Well, one of the core tools is this VWAP rule. For a long trade, it's not enough for the price to just be above the VWAP line. It needs to decisively reclaim it, and the line itself needs to be sloping upwards. The protocol is strict. It demands at least 2 consecutive price bars, or candles, closing above that line to prove it's not just a fake out. And of course, you still need the sector and the Treasury yields to be aligned with the move. See? It's a multi-layered confirmation process.
Now here's another pro-level concept for you. After a big move up, the first time the price dips back down, that's often a trap. It's designed to suck in impatient buyers right before the market shakes them out. So professionals, they just ignore it. They wait for the second pullback to a key level like VWAP, and they're looking for very specific clues. The dip has to be shallower than the first one, and the trading volume should dry up on the way down and then pick back up as the price starts to move up again. That is a much, much more reliable signal that the trend is about to continue.
Okay, so you found a setup. It meets all these crazy criteria. But before you even think about clicking that buy or sell button, there's one last mental check, the 5-second pre-click filter. You have to ask yourself these 4 questions, and the answer to every single one has to be a definitive yes. Is the hierarchy aligned? Is the stock liquid? Is the pattern clear and structured? Is the entry signal confirmed? If there's even a hint of hesitation, a single no, the trade is off. No exceptions. Simple as that.
And that just perfectly sums up the entire philosophy, doesn't it? It is not about predicting what's going to happen, it's about aligning with the hard evidence the market is giving you, right here, right now.
You know, the final piece of this whole puzzle is probably the most important. A brilliant entry strategy is completely useless if you don't have an ironclad way to manage your risk and, even more importantly, manage your own emotions. This is where discipline becomes your real competitive edge.
The risk rules are super strict, and they're designed to do one thing above all else: protect your capital. So you start the day with a smaller position size, risking less than your standard amount on any single trade. You only earn the right to trade bigger after you've had a clean, successful win. And here's probably the most powerful rule of all, the max loss rule. 2 consecutive losses, and you stand down. You are done trading for the day. That's not a punishment, it's a circuit breaker. It's designed to stop you from going on tilt and turning a couple of small losses into a day that destroys your account.
So let's wrap this up by recapping the core mantras that hold this entire protocol together. First up, I trade what holds, not spikes. What does that mean? It means you're trading based on confirmed levels of support and resistance, levels that have proven they can hold, not chasing some crazy vertical price spike that's probably going to reverse just as fast as it went up.
Second, and really if there's one rule that ties everything we've talked about together, it's this one. I trade alignment, not prediction. Your job is not to be a fortune teller. Your job is to be a detective, an evidence-based detective, aligning your actions with what the market is actually doing moment by moment.
And third, I wait for structure after volatility. This is the absolute essence of patience. You let the wild, chaotic, unpredictable part of the market just burn itself out. You sit back and you wait patiently for a clear, readable, and tradable structure to emerge from all that noise. That is where the real edge is.
So we'll leave you with this final thought to chew on. In a world that just prizes instant reaction and nonstop action, what if the single most powerful and profitable move a trader can make is to just take a deep breath, follow a disciplined process, and simply pause?